Well, hello and welcome to our webinar. I hope you enjoy today's webinar on Furnished Holiday Lets. Furnished Holiday Lets are a very important aspect of the tourism sector, as you'll be aware, and we do an annual tourism survey every year, and the 2024 survey results are already out. We did that earlier this year, and the results are quite interesting and therefore quite something for you all to engage with. And on that note, if you are running a furnished holiday let in East Anglia, then again, I would encourage you to engage with the tourism survey survey for 2025, which will be coming out next year. I'm also going to plug our budget webinar because I think there's going to be a number of big changes. If Sally doesn't mention it, then I would be surprised, one of my fellow speakers today, but I just want to get that plug in. I'm sure she'll get a plug in for it as well, but 12 noon on the 31st of October, make a date for that as well. So what I'd like to do is introduce you to our formal webinar today, and that is the Furnished Holiday Let FHL regime, which is all about the abolishment that's been announced in this year's budget and the changes that have come along. You'll be pleased to know that I'm not going to be doing all of the presentation today. That's a relief for you all, isn't it? So I'm going to be helped by our head of private client, which is Sally Farrow, who also covers private client trusts, probate areas and everything else, and Jordan Smith, who is one of our property specialists, and they'll be going through the detail of what we're about to present today. I'm Chris Scargill. I'm Head of Tourism, Leisure and Hospitality, and so therefore I have a great passion for this sector. And so we're going to go through an introduction to Furnished Holiday Lets. We're going to talk about the impact of the changes. We're going to talk about the implications for individuals and for companies. And then anything we haven't covered, we will wrap up towards the end. If there's anything that you ask now that we don't get a chance to deal with, we will come back to you. So please do not hesitate to put a question in the chat box, either as we go through or at the end. And we hope to wrap up about 1 o'clock. So that's the sort of timing for today. Now, I did mention to you that we would be looking at some polls. So let's start with one to begin with. Warm up your fingers and your engagement. If you sold your property now, who do you think ultimately the buyer would be? Would it be another furnished holiday let owner, based on the nature of the size of the property? Would it be a second homeowner who visits the property on a regular basis, so therefore very much part of the local area? A second homeowner who only visits occasionally? A local individual who will work within a 15-mile radius? Or indeed an individual retiring to the area? So over to you. Okay, the answer is quite close, really. A number of people, second homeowners will not let, but will occupy it regularly. 23% said that. Individuals retiring to the area, 21%, and just in the lead would be a local individual working within a 15-mile radius, which when we come back to the purpose of the legislation that's being brought in, it's actually quite interesting that that was one of the outcomes that the government hoped would be taking place. So let's have a quick look at what the legislation brought and how the journey has arisen. So basically, in 1984, there was some very advantageous legislation that provided a distinction for furnished holiday lets. That was during Margaret Thatcher's government, and it provided more beneficial tax treatment for short-term lettings within the property investment sector. So what makes a furnished holiday let? Well, you're probably already aware of the rules, but just to remind you, they have to be a property located in the UK or the European Economic Area. The property must be commercially let. You exclude from it days of 31 lets or more, but as far as the availability is concerned, it's 210 days available for let, and it must be let for 105 days. There are some exemptions, which you're probably aware of, which is the averaging election if you've got more than one property, or indeed there's a period of grace if for some reason you don't manage to let the property for the full period in one or particular years. So then what happened? In 2022, the Office of Tax Simplification was looking at various areas to reduce complicated taxes, and they identified that there's only 128,000 furnished holiday lets owned by individuals taxed in the UK, of which 111,000 were in the UK and 17,000 were in the EEA. So to put that into context of the number of tax returns that furnished holiday lets affected, there were 12 million tax returns filed that year. So it's a lot of legislation for a very few individuals, and that's what they were really targeting. But it probably came a little bit out of the blue that in the budget this March, they announced the changes, bringing into effect the rules from next year, April 2025, 1st of April for companies, 5th of April for trust partnerships and individuals. The intention was therefore to promote a level playing field by removing tax advantages for furnished holiday let landlords over other residential property landlords. The income and gains from a furnished holiday let will therefore form part of the UK and overseas property business, with no separate records being needed to be kept. So simplification, and to possibly balance out the volume of long-term rental properties and those available to locals to purchase. And we just now saw in the poll that the majority were thinking of that. There was some suggestion in the legislation that for those larger complexes there would be some exemption, but the legislation proposed is silent on that, and we'll explore that a little bit later. So what are people going to do? Well, what we then happened was we then looked at the changes in the rules. So from 29th of July 2024, they announced the draft legislation, small window to feedback on that. So effectively that's coming into place. We are not aware of any changes at the moment that have taken place. And then in the autumn budget, 30th of October, just ahead of the webinar that I mentioned earlier, there may be some further changes, which again, we'll look at talking about today. So the conclusion basically is that the furnished holiday let regime will come to an end in April of next year. So enough from me, I think. Let's have a look at what the tax implications are for individuals. So for this, I'm going to pass over to Jordan Smith, who is an expert in our property taxes team. So hello, Jordan, how are you today?
Good, thank you, Chris. Thank you for the handover there. So yeah, we've got a few income tax implications to consider. I'm going to go through sort of 6 of the main changes. Some of them are going to have a larger impact than others. So first off, we've got ownership. At the moment, with furnished holiday lets, owners are allowed to allocate the profits in a way that is different from the legal ownership, usually in line with the participation in the business. This is very key for married couples. When the new rules come into place, that's all going to change. For married couples, the default position for splitting profits will be 50-50. However, there is an option to legally change the beneficial ownership and then do a specific Form 17 to HMRC in order to declare that your profits will be split in line with the beneficial ownership. Now, that is a process that's going to need guidance between, deciding on what split is beneficial and what to do next. So that's something that we can definitely help with. For unmarried couples, joint owners can agree a different division of profits each year, but the actual split and the distribution of profits must follow that. So, i.e., profits are deposited into personal bank accounts in line with that ownership split agreed. And we always suggest that a declaration is signed annually, just agreeing that split should HMRC ever come back and question it. The next topic is capital allowances. Now, at the moment, furnished holiday let businesses can claim relief on the initial acquisition of capital items. That's fixtures, fittings, bed linen, cutlery, electrics, that sort of thing. However, when the new legislation comes into place, that relief is going to be removed, and you're only going to be able to claim for the replacement of items. Now, if you have regular buy-to-let properties, that is in line with current rules that you're used to there. So that's one thing to be wary of. Next up, we've got loan interest. Now, this is going to be the headline thing that is going to affect quite a lot of property owners, and probably quite largely as well. So at the moment, with a furnished holiday let, you can claim relief for 100% of the interest on loans or mortgages that you have to purchase the property. Now, that gives you relief at your marginal rate of tax, 40%, 45%. However, with the new rules, they are going to be in line with the current long-term buy-to-let rules, meaning there's only going to be a special relief for finance costs, which is going to be available after the taxable profit is taken into account, which doesn't include interest. Now, that special relief is only available at 20% of the interest. So if you're a higher rate taxpayer, you can see where you're taxed on the profits at 40%, but interest relief is only at 20. And now that relief is also restricted to the lower finance costs actually incurred in the year, plus any brought forward, actual profits for the year after losses brought forward, and then income in excess of personal allowance. As that is going to be a thing that's going to affect quite a few people, we'll cover that up in an example. Next up, we've got losses. Now, this is actually could be a welcome change for those people that have furnished holiday lets already. At the moment, the current rules mean that any losses generated by a furnished holiday let can only be offset against the future profits of a similar furnished holiday let business. However, with the new legislation comes into place, those losses will now be available to offset against all rental businesses. So if you have a furnished holiday let and long-term lets, that loss is now going to be able to be offset against any profits from your long-term let or rental business, which we'll come to an example on as well, could have an impact in accelerating the beneficial use of those losses and, accelerate the tax savings from them. Next up, a small position on pension contributions. And that is that the furnished holiday let profits in the past have been deemed as qualifying relevant earnings for pensions. However, that is no longer going to be the case. So individuals who are utilising the benefit of using pension contributions are no longer going to be able to have that. It'll have to be stuck to the limited restriction of 3,600 gross. So next up, we've got the example on loan interest. So a higher rate taxpayer with annual mortgage interest of 10,000, with overall profits of 40,000 after the deduction for regular expenses. On the current rules, the taxable profit will be 30,000, taxable at 40% of 12,000 tax liability. However, when the new rules come into play, this mortgage interest will no longer be a deduction from the property income when arriving at the taxable profits. Instead, what's going to happen is they'll be taxed at 40% on the 40,000, liability of 16,000, and then a 20% deduction for the 10,000 finance costs of 2,000, and overall property liability of 14,000. You'll see here there's a £2,000 increase in the tax just on that change coming into place. Next up, we're going to look at an example with the losses involved. Now, we've got an individual here that owns 5 properties. 4 of them are long-term buy-to-lets, and 1 is a short-term furnished holiday let. Each property generates an annual profit of 10,000 a year. So, carried forward from a previous year, we've got furnished holiday let losses of 35,000. Now, that has been generated, say, from a capital allowance claim where the the owner has gone through and made sure they're claiming for all fixtures, fittings, bedding, electricals. So, based on the current rules, that £30,000 loss will only be available to offset against the 10,000 furnished holiday let profit. Now, at 10,000 a year, that will take over 4 years to be able to claim all of that relief. Based on the current rules, the tax liability would be 40,000, being the 4 buy-to-let properties, which is 16,000. However, with the new rules coming into play, that 35,000 loss will be able to offset against the whole 50,000 profit. Now, the benefit of that is it's accelerating that tax relief there. And so the taxable profit for the year would be 15,000 at 40% liability. We've got 6,000 in tax. Overall, a £10,000 tax saving. As you can see, that is a significant sort of win for these changes in rules. So back to you, Chris, to take some key takeaways.
Thanks, Jordan. That was excellent, and quite a lot of detail there for people to absorb. So the things that I was looking at there was ownership planning is obviously quite important. There's some big changes there, lots of flexibility potentially still, but most of it being taken away. That loan interest and mortgage refinancing is quite challenging and going to be quite expensive for a number of people. So presumably there's going to be an opportunity again for planning, looking at where else the mortgage or loan may be redirected in order to get higher tax relief. Capital allowances claims, again, something to look into. If you haven't looked at the wider range of backdated claims, then now may be the time ahead of the 5th of April. And also the 2024 tax return is still open probably for the majority of you. So again, something there to consider. Pension contributions, again, a big thing to start planning for now, because the 5th of April is fast approaching. And of course, we have got the budget changes. So again, maybe we need to be thinking about some of these things before the 30th of October. But there is some wins. Those people who are running furnished holiday lets, perhaps with losses, who are thinking of bringing to an end their furnished holiday let activities and moving into lettings in any event, there's going to be a win for them because they're no longer going to be have those losses locked. So again, some positives in amongst that. So Jordan, just looking at the point of married couples, you flagged that there was some changes, but we may need some legal advice in there as well. So how does that work, and what changes? Is there still a possibility of benefiting a lower taxpayer?
There is definitely still a possibility. However, the steps involved in order to achieve that are a little bit more complex now. So, as I said, the default position will now revert to a 50-50 split of profits. However, with married couples, there is an option to vary that in line with the actual beneficial ownership of the property. Now, there's two steps to this. There's to first vary the beneficial ownership, which is a legal case document, which in most terms is what they call a declaration of trust, and that is where legal help will be, required. And then the second step is what we call a Form 17 declaration. Now, this is a specific form that a couple must submit to HMRC within 60 days of signature, which basically allows them to treat the distribution of profits in line with the legal ownership. Now, we see here that we have a timing issue, that form has to be signed after the declaration of trust is made to change the beneficial ownership and arrive with HMRC within 60 days. So this is a planning opportunity where you need to decide what is going to be the beneficial split. And due to the involvement in this process, it's best to do that on a long-term basis, because doing such variation and declaration every year, there's quite a lot of involvement. Costs might outweigh the benefits. There's also another thing to consider here is if there's any debt on the property, the transfer of ownership will also mean the transfer of mortgage debt, and there could be stamp duty implications here. And also it's worth checking with a mortgage advisor if your current loan mortgage on the property is even able to change along with the ownership of the property. So whilst there is a possibility of doing it, and there's a few more steps involved, let's look at it on a long-term basis. Is that split going to be suitable on a longer term? And B, can we make sure it's actually possible with the mortgage? And then C, is there any stamp duty hidden costs that might outweigh the benefit on the longer term?
Okay, brilliant. Some really key points there. And the number of times that I will take on a new client and they won't have done the Form 17, but they'll have a strange arrangement in place is quite interesting. So that's income tax, I think, covered for now. Plenty of questions if you want to raise them for Jordan later. But for now, let's have a look at capital gains tax for individuals as well. And for that, I'm going to pass over to Sally Farrow, my colleague. Some changes there that are quite challenging, Sally?
Yeah, so I guess maybe start off with the default position. So that won't change. So it's a furnished holiday let property. It's a residential property, so the residential rates of capital gains tax will apply. I guess the key is unless there are any reliefs that are due, and that's where we're going to see some changes. So we'll cover those in this session. So just to recap, so the current residential rates are 18% for any element of the gain that falls within the basic rate band, and then a 24% rate for high rate taxpayers. That tax needs to be paid within 60 days alongside the submission of a separate capital gains tax return at the same time. So as I say, they are the default current rules and they will continue to apply post 5th of April 2025. However, currently there are reliefs that are available specifically for furnished holiday lets, and it's these reliefs which will be lost moving forward following the abolition of the rules. So firstly, let's look at business asset disposal relief. Some people may be more familiar with the terminology entrepreneurs relief. The government did change the name of it a few years ago, and that means that if you qualify, the disposal of your furnished holiday let can attract a 10% rate of capital gains tax. And again, that's provided you haven't used up your lifetime allowance of £1 million. So, you may have sold, shares in a trading company, for example, that would eat into your 1 million allowance. So that's something that's just worth checking. So broadly, to qualify, the most you must have received a minimum of 5% of the income from the property for the last 2 years up to the cessation of your furnished holiday let business. So linking into what Jordan was saying, married couples, they may have done some planning. So we just need to make sure that there is a 5% holding. It also must meet the furnished holiday let qualifying conditions for that 2 years up to cessation. So they are the rules that Chris recapped on at the beginning of the webinar around the property being available, how many days it's let. So that is your 2 years up to, I then refer to as cessation of your business. So at that point, your furnished holiday business has to come to an end. That means the whole business, if you've got multiple furnished holiday lets, they all must cease for you to be able to potentially benefit from this 10% capital gains tax rate. So with the abolition of the furnished holiday let rules, the timing of any disposal is really going to be the key in this transition period. Your furnished holiday let business will need to cease on or before the 5th of April 2025. But then with business asset disposal relief, you have a 3-year period post the cessation of your business for business asset disposal relief to still apply. So therefore, when we get to the 5th of April, this 10% capital gains tax rate isn't necessarily lost. So there is still planning and opportunity there. The abolishment date of 5th of April 25, that doesn't count as a deemed cessation of your furnished holiday let. There needs to be an actual cessation. So you will need to stop the lets as a furnished holiday let business and wrap that up. So I guess if you are thinking about possibly selling, do speak to us. We can help work through the timings with you, help you take the necessary steps, just so you're clear on what rate of tax would be payable, and as I say, whether there is some timing there to make it better. If your furnished holiday let business ceases after 5th of April 25, then there will be no ability to get business asset disposal relief. So I say that cessation is key. So next we will move on to business asset rollover relief. So currently, if some or all of the proceeds from the sale of a furnished holiday let are invested into another qualifying furnished holiday let, that gain can be rolled over. So effectively, rather than crystallising your capital gains tax liability, the capital gains tax is deferred until the new property is sold. So that can be really helpful where people want to stay as furnished holiday let owners, but maybe decided they want a bigger property or and they want to change. That can be a way just to avoid a capital gains tax liability. Under the new rules, once furnished holiday lets rules are abolished, they will no longer qualify as replacement assets for this relief. So this one does have a hard 5th of April 25 cut-off. So if you've already sold or in the process of selling a furnished holiday let and are looking to reinvest into a purchase of a new one, that has to happen by the 5th of April if you want to be able to get the rollover relief. Next up is gift holdover. So if you've got a business asset, which a furnished holiday let should meet that condition, and you give that away or you sell it for less than it's worth, so sort of a sale under value, then again, the capital gains tax isn't paid at that time. You hold over the gain, and it's the donee, so the person who you've gifted the property to, they would effectively have to pay that capital gains tax at the point they sell or dispose of the property in the future. Again, with the changes, this rule, holdover relief, will cease to exist from 6th of April 2025. So the gift would need to make sure it's completed prior to 5th of April if you're relying on holdover relief. So this is where we quite often will see and rely on this relief when it's part of inheritance tax and succession planning, maybe where people are looking to pass property down to the next generation. You know, this just enables you to do it without the capital gains tax charges. It is worth noting that there is a different form of holdover relief, and that applies where a gift is made into a trust rather than to an individual. This works in a slightly different way. So this relief won't be lost post 5th of April 2025. So we may see people opting to actually do inheritance tax planning with use of trusts more, where they're looking to try and to rely on holdover relief as part of their succession planning. And finally, just a mention on the anti-forestalling measures. It's pretty standard practice now where the government announces changes ahead of when they're going to be introduced, that they will also put in place some anti-forestalling measures, just to really make sure that people aren't obtaining a tax advantage through some means to still tap into the old rules, where really they haven't concluded their transaction by the 5th of April in this case. So for the Furnished Holiday Let provisions, it's really where people are going to try or look to use an unconditional contract to be able to obtain a capital gains tax relief under the current rules. So these anti-forestalling measures, they're already in place. They come into effect from budget day on the 6th of March. So these will apply where there is an exchange of contracts. And so an exchange of contracts is our disposal date for capital gains tax. And that disposal, so the contract is from 6th of April 24, but actually the completion takes place after 5th of April 25. So it looks to deny the relief for things like the rollover and the holdover, where that transaction or that transfer is between connected parties. There is an exemption. So if there's a third party transfer that's undertaken wholly for commercial reasons, there'll still be a need to disclose that fact to HMRC, but even where that completes after 5th of April, it should still be okay. It really is where there's a connection and people are just trying to effectively manipulate the rules to still get the advantage of the tax reliefs. Finally, as a taxomiser, my normal caveat, I would say everything I've said is based on current rules and the legislation that we now have for the abolition of the Furnished Holiday Let rules. What we can't rule out is any further changes in the upcoming budget. Don't want to let Chris down, so I better do a plug. We are doing our typical live webinar the day after, so on the 31st of October. So if there are any further changes to capital gains tax or anything else for that matter that will have an impact on what we've discussed today, we will make sure that we cover those in that webinar. We'll make sure that registration links are sent out to everybody after the webinar today. So that's it for me. So I'll hand over to Chris.
Thank you, Sally. Again, a lot of detail to take on board, so plenty to think about there. Key takeaways, of course, is the selling of the property before the 5th of April to secure that business asset disposal relief. And again, there's some possibility that that may change in the budget. We'll come back to that in a second. And the no 3-year window for the rollover. If you're selling now, no 3-year window. So again, something to really start making people think what they need to be doing today. And the 5% share, Sally, there's a number of businesses or furnished holiday lets at the moment whereby perhaps one taxpayer has had 0 income from the partnership and they recorded that within Land Revenue, so they won't get business asset disposal relief?
No, because they won't meet the qualifying criteria, and that has to be criteria for 2 years. So, you know, it's not something that can be fixed now. You need to do a look back. So no, if somebody hasn't necessarily been taking that 5% share of income, then potentially they will not qualify for the 10% capital gains tax rate.
Okay. But again, I think it's worth speaking to your tax advisor to make sure what you've been doing and what you've been doing for the recent past. Okay, excellent. It's participation time again now. So let's have a look at what the next question is going to be. So based upon what you know, what, if any, impact do you think the Furnished Holiday Let changes will have to property prices? Now, I think we've got one or two estate agents on today, so they'll be very interested in this question. So is there going to be no change to property prices, neither up nor down? Is it going to be prices will accelerate? We've always seen property moving positively for the majority of time. Prices will fall due to a lack of demand for properties of that size because a number of furnished holiday lets are too small, or a number of them are very large for the multi-generational market, or prices may fall just simply due to oversupply as a result of a lot of people getting out of the market. So what do you think of those four answers would apply to the sector? Okay, the majority, nearly 40%, so suggests that 4 in 10 suggest there's going to be no change. So actually it's going to be a neutral market for a while, no prices up nor down. Only 4% suggest that the market may actually accelerate, despite the fact that the suggestion earlier was that in the earlier poll that the properties would be sold to people working in the area where there'd be demand for that, you'd think. So maybe they're going to take advantage of either no changes in markets. 28% say that there's going to be a fall in prices due to a lack of demand for the type of house you've got that you might be wishing to sell, and 29% suggesting that there may be a risk of oversupply. So quite close on that, but no change seems to be the main answer. Okay, so we've touched on a lot of areas at the moment affecting the individuals. So what's going to happen to companies? Maybe not quite so many changes there. So I'm going to pass over to Jordan Smith, who's going to cover this area for me. Not quite so far reaching here, I don't think, Jordan.
No, Chris, the changes here are going to have less of effect on those who are operating their furnished holiday lets through a company at the moment. So this section is a little bit more straightforward. There's going to be no changes to the tax. The corporation tax rates, as we know it, are the same. There's no issue with losses. Any losses brought forward will be able to be offset against future profits. Again, interest is still going to be explainable 100% as an expense, which is sort of a big win for those operating through a company. And then the way that you're extracting the money personally from the company via, say, salary and dividend is going to remain the same. Also, there is no 60-day CGT reporting if the company sells a property. However, I will caveat that if you sell shares in a property company, there is 60-day CGT reporting personally on that. There's 3 points to mention where people are going to recognise the change. Firstly, capital allowances. Like I mentioned personally, you'll no longer be able to claim relief for the initial capital acquisition. So, if you're starting a new business, there's going to be an effect for you there. However, ongoing businesses are still going to be able to claim the replacement of items. As Sally mentioned, business asset disposal relief on the sale of the shares is no longer going to be available. So there's a key there. Again, the same timing consideration should be had as if you were selling the property itself. And finally, at the moment, you're able to roll over any corporation tax due on the sale of a property, because in a company, there is corporation tax to pay on the gain. At the moment, you can roll that over if you purchase another qualifying furnished holiday let. However, that is no longer going to be available. So they are the 3 sort of key differences. And as you see, there's less of an effect there. So I'm often asked, what is the difference between owning a property personally or via a company? So let's go through those options now. One of the big ones which people gravitate to is the allowability of mortgage interest. As I said earlier, with individuals, you're only going to be able to claim a basic rate 20% relief personally. However, in a company, you'll be able to expense 100% of the interest. Now, I'll start here and say that following the change in rules, these apply to whether you're owning short-term furnished holiday lets or long-term buy-to-let properties. So for a wider audience, that might be relevant. Tax rate on the actual rent itself. For personal individuals, that's your basic 20%, higher 40%, and additional 45% rate. For companies, if profits fall below 50,000, it's at 19%. If profits fall above 250,000, it's 25%, and then there's a marginal relief in between, going from 19 to 25. On gains, Sally mentioned that these are taxable, personally at either 18 or 24%. If we're saying here that business asset disposal relief is no longer available. And then the next up is company. As I said, it's done at corporation tax on the gain. Now, what if you want to spend this money personally? So from a personal perspective, the gross profit is already yours. You don't need to worry about extracting it from another vehicle. Whereas in a company, your profits after taxes are paid are sat in a company and you need to extract them for personal use. Now that can be via salary and dividends, and some planning can be done around there with the way that is extracted and how the shares are set up. Or if you don't want to extract it, there's options to leave it in the company, and invest in other assets. Now, many people that are purchasing these properties do so with loans, with mortgages. And so interest rates are, a big question mark. More and more sort of banks and building societies and specialist loan providers are now lending to companies. However, it's still early days as to that's happening. So, when you're considering personal versus company ownership, one of the first questions to ask is, can I get a loan in a company, or can I transfer my current loan into a company? There's some implications there if you aren't owning your properties outright. Next up, some of these short-term furnished holiday lets are in lovely areas of the country, and lots of owners like to stay in them personally. When you own it personally, it's quite simple. You just restrict the relevant costs based on your personal occupation. So we're increasing your taxable profits a little bit, but there's no other consideration. However, in a company, if you're staying in a company-owned property, there's a benefit in kind. Now, there is a P11D benefit, which is taxable if you don't do anything. However, the other option is to pay the going market rate for the rent for the period you stay. Now, that could be quite costly, and it's an expense that is deemed to go from yourself to the company, and something that some people would like to avoid. The following two items are some more different taxes here. We've got ATED, which is annual tax on envelope dwellings. Personally, nothing to worry about there. For a company, this could apply if your property is worth over £500,000. However, for property rental businesses, there is an exemption that can be claimed. Now, whilst there might not be an actual tax liability, there's increased compliance with annual returns required in order to claim the exemption. For stamp duty land tax, if you're buying a second property personally, a 3% premium applies, and the same 3% premium applies for properties purchased by a company. Now, that £500,000 threshold is also there for a 15% surcharge. However, again, there is some specific exemptions that can apply, but we are talking more compliance when you're on the purchasing process.
Thank you, Jordan. A whiz through there, but some really key data again. I mean, so much to absorb for individuals. You touched upon this is a limited company. So if I owned myself a furnished holiday let that was used and sort of advertised and promoted through an agent who did all the cleaning and everything else, should I be considering incorporation? Would it work for me?
In the short answer there, Chris, is probably no. The main barrier being a recent tax case, which was Ramsey versus HMRC, where in order to claim incorporation reliefs, which would be the tax benefit of incorporating, the individual was having to work in the business for at least 20 hours a week. So that sort of shows the level of activity needed in order to claim such relief. If you're letting through an agent, it's very unlikely that you'll be able to prove that 20-hour threshold.
Okay, thank you. And so if I was letting it, say, with another person, either a spouse or a civil partner, or indeed a third party, and we were running that ourselves and we had multiple units, would the answer be slightly different?
Yeah, so there's definitely the option to do so. If you can first off demonstrate that 20-hour a week threshold, there's the possibility of claiming corporation tax relief, which the benefit will be any capital gain arising on your property, which is the increase in value since you've purchased it, could be rolled over into the company. At the same time, there's some stamp duty considerations. Now, if you're not already trading in what we'd call a registered partnership, now that has got a lot of hoops to jump to in order to be classed as registered. There isn't a specific stamp duty exemption on that transfer, so you will be taxed at the market value of the property into the company. And I sort of touch on that exemption for the stamp duty. There's a few, as I said, hoops to jump through, and it's something that is definitely worth taking advice on, just to ensure that you're making sure the timing and the rules are hit. Because if we don't hit that incorporation tax relief threshold, there's a significant possible capital gains tax charge, a stamp duty tax charge, and that's all based on the current market value of the property. And when we're transferring from basically yourself to your own company, there's no proceeds changing hands. So what's what we call a dry tax charge. So there's a significant amount of tax outlay now with no money being generated for it. So it's worthwhile considering, is that going to be right for you, cost benefit long term? So you're going to have a short term expense. Is it going to be good long term? Now that is something that we can help you plan around. We can do pros, we can do cons, and we can sort of model cash flow to see, when it might be beneficial for your individual circumstances, because everybody is different, to perhaps make that jump.
Excellent. So it's not straightforward. Take advice, think about it, but the key is going to be clearly thinking about it now and not wait till nearer the 5th of April when it may be too
100%.
late. Okay, thank you ever so much, Jordan. So we've covered income tax, we've covered capital gains tax. We're now going to look at some other aspects, but just thinking about the earlier presentation, Sally, you talked about business asset disposal relief. Is there any chance that that may go in the budget?
I'm not very good at budget predictions. I always get them wrong, but it is something that has been talked about. I have read it in the press, so it could have an implication here for the Furnished Holiday Let owners if it does, because I've talked about this 3-year window. We will probably be relying on that relief still existing during that window. So again, when you're thinking about timing of like now, later, you need to bear in mind that there could be some further sting in the tail when we get to the budget.
And if it isn't abolished in the budget, you highlighted the point about the 5th of April and cessation. So just remind me what cessation would mean for a business?
Yeah, so your Furnished Holiday Let business would need to cease. So you'd need to stop advertising. You couldn't have any more people staying at your properties on a short-term basis. So that then gives you options. You either leave it empty while you're trying to market it, you use it yourselves, or long-term lets, if you wanted to rely on that 3-year window, put it back on, put it on the market in 12 months time, you could do it on a 12 months short hold tenancy. That wouldn't affect your cessation of your Furnished Holiday Let business.
Okay, so that's me interrupting you, because I was just about to hand over to you on all the other aspects we haven't cleared, because there's so much to discuss here, Sally. So over to you on what we haven't already covered amongst the other things.
Yeah, so I'll just do, I say a few other topics. First one, we haven't mentioned inheritance tax, so just a couple of lines around that. It's fair to say probably the default is it's not changed. HMRC, while they deem Furnished Holiday Lets to be businesses for some taxes, they're very much of the view that a Furnished Holiday Let is an investment, not a business activity when it comes to inheritance tax. So people may have heard of the relief, business property relief, which can apply at the rate of 100% to qualifying business assets. It's really, really hard to get HMRC to agree that any kind of Furnished Holiday Let activities have sufficient activity services for that relief to apply. So really no change when it comes to inheritance tax. The next one, again, which is probably no change, is VAT. The draft legislation was silent on VAT, so it seems likely that that means there are no planned changes for the VAT position. Therefore, if you breach the VAT registration limits, you will continue to need to charge VAT on the rents, as short-term lets fall within the scope of VAT. If you're thinking about selling the property or moving out of short-term lets to long-term lets, and you are VAT registered, then just get advice just to work out whether it's sensible to continue with that registration. You need to stop that registration. At Lock&Gown, we have dedicated VAT team headed up by Gillian McGill. She would be happy to discuss. Her view is whenever there's property transactions or changes of use, just checking the VAT position is always sensible. So in terms of ownership structures, we've talked about individuals and we've talked about companies, but we do see Furnished Holiday Lets being owned by trusts and sitting in formal partnerships as well. I would say a lot of our clients in our farm and rural business teams, for example, were typical farming partnerships. They may have diversified and ended up converting barns or units and having those as Furnished Holiday Lets. These rules just all apply in the same way if it's owned in a trust or a partnership as well. Next, I was going to touch on business rates, council tax. I have actually seen there's been questions coming up into the question box around this subject, so hopefully I'll be able to answer that as part of what I go through now. So if you do Furnished Holiday Let, short-term let, you're in the range of business rates. But normally you can then apply for the small business rates relief exemption, so they're not payable. If you're in long-term lets, then typically it's council tax that you'll be paying on your properties. It's possible that short-term holiday lets may be removed from the business rates registrations moving forward, but currently there's been no mention of what the future holds. So unfortunately, this is something we can't give guidance on today. So it is just keep an eye on this, and we'll see what unfolds. So next, just touching on a new registration scheme. So the government is introducing this new registration scheme for holiday lets in England. It's expected to be operational sometime this year. We don't have a definitive date. It's part of the Levelling Up and Regeneration Bill. It also includes a new planning class for holiday lets, and I think one of the aims is to enable the local authorities to really understand the number of short-term lets in certain areas. Again, it's a watch this space at the moment. We don't have further details. As I say, it's due to be introduced in 2024, so government are running out of time, so whether it gets postponed, we don't know. But again, watch this space and we will share updates as we get further guidance. It's right to mention Making Tax Digital. This is a reminder that it's still coming on the way. We've had various delays. Again, this is an area where my track record of predictions isn't good. When I said, oh no, they won't delay further, and they did. Hopefully, we've got a fixed date and it's coming in. This will apply regardless of whether you still let as a Furnished Holiday Let business on short-term lets or whether you decide to move to longer-term lets. You will need to keep digital records and submit quarterly returns to HMRC. It will apply from April 26, so it's not that far away if your turnover is over 50,000, and then it's April 27 when the turnover limit drops to 30,000, so even more people will come in scope then. Again, I say it's not far away, so make sure that you're talking to us, planning if you think, if your turnover is going to be around those limits. We have softwares that we can recommend and help you on board to enable you to do those sort of quarterly returns and submissions. I would say with those softwares that, they do help make sure that you're MTD compliant, but they have lots of other features as well, which will help you run your property business. So, it's not just an accounting software solution, it has lots of other benefits as well. And finally, I'm just going to touch on cash basis. So this is the cash basis is the default basis for working out your rental income and expenses. So this means you're assessed on your income and expenses paid in the tax year, regardless of the period that they relate to. So this is in contrast to the accruals basis, where you allocate based on a specific time period. So it's probably best explained with an example. If we think maybe expenses insurance is a good example, say you pay your premium in March 2025 for the 12 months ahead. With the cash basis, you would allow all that expense in the 24-25 tax year. But if you've got the accruals basis, you would need to time apportion that. So you would only have a really small amount of that payment allowable up to 5th of April 25, with the balance then being allowable in the following tax year. So under the cash basis, rents, and they would include any advance deposits that you receive, they are taxable when they're received rather than when they relate to. So this can result in an acceleration of tax liability. So quite often we'll see a furnished holiday let owners actually opting for the accruals basis, because popular properties, people will pay deposits way in advance, and it's just working out the timing. So it'll be something that people need to consider post 5th of April to decide, is what they do currently still the best for them going forward. And I say that's especially if you have a mixed property portfolio, so you have long-term lets and furnished holiday lets, because historically you could treat those two different elements. You could have one on accruals, one on a cash basis, because it's all going to be amalgamated moving forward. You're going to have to opt for one for all. So there isn't a right or wrong answer. It really does depend on your income pattern, your expenses, your level of expenses. So it's just something to worth consider as to what is right for you moving forward. So that's it for me. So over to you, Chris, so we can see if we've got any more questions to answer.
Okay, thank you ever so much, Sally. Again, a whiz through on the rules. The cash basis is going to be very interesting, particularly those people who have got, as you say, the furnished holiday lets and the buy-to-lets. There's a lot of press that's coming out. Some people will start seeing that coming through, saying the cash basis is a big change. It's always been in for a while now for businesses turn over £150,000 or less, but it's now coming in for all businesses that are unincorporated. But as you said, it's been in since 2017 for most buy-to-let properties, which have been less affected. So, and then on the business rates time, I mean, again, inconsistency. Why have business rates relief versus council tax? But we're going to have to keep VAT. So again, nothing joining up there necessarily. So we'll jump now, if I may, to another poll, and this is the last poll, I promise, for you before we go into your questions. So having considered what we've discussed today, what are your intentions with your furnished holiday let going forward? So again, this is anonymous. So is there going to be no change? You're going to continue to operate as a furnished holiday let as individuals or partnerships, or you're going to no change, you're going to continue to operate as a company, or you're actually going to change to long-term letting, or are you going to sell or gift the property before the 5th of April 2025 rather, and alternatively, you're going to look to incorporate. So 71%, so this basically, so 11% of businesses probably already in a company, they're going to continue to stay as a furnished holiday let. 71% who are trading as individuals or partnerships are going to continue as that. Change to long-term lettings, 1 in 20 is going to do that. 8% are going to sell or gift, and 6% are going to look to incorporate. So it looks as if you could be very busy, Jordan, in having some discussions on that front. So, okay, so let's go open to the questions and answers. We started off a little bit late, so we've got plenty of time to answer some of the questions that are going to come through. So I'm going to start off with one of the questions that came through, which was a question on the expenditure. There was a question going, well, actually, what's happening as far as the expenditure is concerned? What are going to be the changes? Well, Jordan mentioned about the reduction in mortgage interest relief on properties. Other than that, the same rules are going to apply regarding wholly and exclusively incurred. So if you're paying commission for your furnished holiday let, then that will still be an allowable expense. If you're paying for repairs or cleaning and those sort of things that are directly associated with the trade, then they will continue to be available. I've got another question here that says, are the slides available afterwards? The answer to that is yes. So again, no problem with answering that question. So that's why I've done the easy ones. Okay, Moving over to one of the questions, we have an overseas question, Jordan. So if I can ask you this, my long-term lets are located within the EU. Can I offset my furnished holiday let losses against this income? I'm assuming they're going to mean after the 5th of April next year. So are they actually going to be able to combine those two different effective trade or activities?
So it depends where that furnished holiday let is located. So after the 5th of April, your property businesses in the UK are going to be amalgamated and your overseas property businesses are going to be amalgamated. So if your furnished holiday let is in the UK, then unfortunately those losses are not going to be able to offset against your overseas other properties. However, if your furnished holiday let is in the EU, like your long-term lets, yes, that business loss will be amalgamated. So if it is in the UK, you'll only be able to have that loss against future UK property business income. So that's going to depend on what you do with that property going forward.
Okay, excellent. Sally, a question for you, if I may. If the furnished holiday let is jointly owned by husband and wife and they cease the business on the 1st of April 2025, will there be any capital gains tax liability on the company if they then own and use the property as a second home?
So just clarify, you say company. So is the property owned by them as individuals?
Sorry, in this one, if the furnished holiday let is jointly owned by husband and wife and
Yeah.
they cease the business, sorry.
Yeah, so no, that's fine. So no, that wouldn't trigger a capital gains tax liability. The ownership of that property hasn't changed. So if they continue just to use it personally or let it on long-term lets, it would only be at some point in the future if they decided to sell it, would that be a capital gains tax event? So no capital gains tax payable.
Okay, excellent for that. Okay, we've covered the council tax questions. I've got a question here for Jordan. If I ask you this question, if a furnished holiday let is purchased with cash by a limited company, can the cost of the property be claimed back and offset against future years' profits? I'm guessing this is not the capital allowances within the property, but the property purchase itself.
Yes, so as we're looking at the property purchase by a company, that is going to be an asset on the company's balance sheet. So unfortunately, that will stay on the company's balance sheet until it's eventually disposed of. So there is no ongoing relief available for the initial purchase.
Sally, we talked about purchasing as a cessation. Is it best to buy your next furnished holiday let before or after the 5th of April as a partnership? Now, I'm going to assume that this question means your next furnished holiday let means they've already got one. So should they buy then an additional property before or after the 5th of April?
I'd say it probably depends on the exact circumstances, but given if you're buying a new property, there'll probably be a lot of capital spend and maybe some, as part of that acquisition, then actually doing it pre-5th of April could be sensible because you might be able to maximise then any capital allowance claims. But I say we just need to really understand what exactly the current structure is, what's being proposed, but quite possibly you'd want to move before 5th of April.
Okay, thank you very much. A question back on the income tax for you, Jordan. Would a replacement, and that's very, very kind of them to state that, electrical appliance such as a dishwasher or fridge be classified as a capital purchase or a replacement?
Yes, so white goods are what they class as domestic items. So that is, you'll get relief as a replacement. That doesn't go in as capital, i.e. a relief against the eventual sale. So yeah, you'd get relief in the year of that was purchased, either at the moment, on the capital allowances, but going forward as replacement of domestic goods, which is just an expense. So 100% deduction. For the replacement. I will caveat the said replacement, not the initial purchase.
But if they bought it now and they were operating in trades today, then presumably they could claim the capital allowances today. And then if they replace it in due course, they'll be able to get the replacement asset relief
Correct.
as well.
Yes.
Excellent. Okay, the questions are coming thick and fast now. We are running short of time, so we will look to answer these outside the webinar. If I'm looking to buy equipment before the 5th of April 2025, are there any restrictions on the capital allowances that will be available on these purchases? Sally, maybe that's one for you.
So no, normal capital allowance rules apply up to 5th of April. So if it's something that qualifies, it will be okay. Again, it depends on the nature. It may be that if you've claimed annual investment allowance, it's 100% deduction in this year. So you'll be increasing those losses to carry forward that Jordan touched on, or it could be that it's something that enters into a capital allowance pool. We know that that pool will carry forward, so you'll continue to then get relief on that. It's just any new expenditure after 5th of April where capital allowances won't be able to be claimed.
Okay, thank you very much for that. I've got a question that probably I ought to answer because I was the one that raised the 105 and 210 day limits. The question is, I presume that the 210 days, 105 day limits will no longer apply. I think the answer to that is correct. The properties are no longer going to be, they are going to be short-term lets as opposed to furnished holiday lets. And so as a result of that, I think that we are going to drop that legislation. And the one thing I didn't ask you, Sally, and I'm just going to raise that with you. I mentioned earlier about the bright line changes and those businesses that have got multiple lettings, maybe a farm with 10 or 15 converted units. They're arguably going to become a property business now and treated the same way. Or is there a chance that there may still be a trade going on?
Well, I think that was the whole point and the idea behind the bright line is to actually give us some clarity in that situation where they wanted to introduce like a set criteria so you could determine whether it's property letting or whether it's sufficient to move over to the other side to be trading. Obviously, the government haven't taken that idea forward. So again, we're left in a grey area as to what's going to unfold. As you say, some on a larger scale, would probably try to argue that they're trading, but we're going outside furnished holiday lets. Typically, we'll see it with caravan and campsites where it's really quite rude to them when you go, oh, that's an investment, because they're working really, really hard. It really is a business, but it doesn't always follow through for the tax rules. So I think it'll be interesting to watch this space moving forward to see whether we're given any more clarity. And I'd imagine we'll end up seeing cases where people are arguing that they're trading, and then HMRC will be pushing back saying, no, it's property letting. So the bright line would have been good because it would have given us that criteria and some clarity, but they didn't take that idea forward.
It would have been really, really helpful, wouldn't it? So again, I just think again, in that case, if there was going to be an argument for trading, then the 210 day, 105 day wouldn't apply anyway, because you're looking at that as being a sort of 365 business activity. Okay, I think we're going to wind it up there. I've overrun my time. Hopefully a little bit of added value, which Larkin Gowan always give, is what I'm going to say. So we've overrun a little bit by that. So I'd like to thank my fellow presenters today, Sally Farrow and Jordan Smith, for their insight. I mean, what fabulous insight they've given us in the detail. You are going to get the slides afterwards. Our email addresses are on there, so please feel free to give us a note that you would like answered, and we will follow those up. We've got several questions still coming through, so again, we will look to answer those directly with you as well, and have a chat. And yes, they'll be free as well. Don't tell anyone that. Don't tell the managing partner I said that. Okay, right. I'd also like to thank the team behind the scenes, which you can't see, who have helped put this webinar on today, and also for the technical support from two of our tax specialists, Mel Howard and Summer Dyball, who are both part of the Furnished Holiday Letting team that we think is one of our strengths. So thank you ever so much for joining us today. We hope you've enjoyed it. Please send the questions on to us afterwards. I would like to plug again, for those who missed the first 2 or 3 minutes, that we do a tourism survey every year. Furnished Holiday Lets will continue to be a very important aspect of the tourism sector, so your views do count, and we would like some feedback on that. I'm sure the 2025 survey will touch on that. And then if you haven't had enough of Larkin Gowan, then please do join us on our various insight pages. We've got lots of podcasts covering everything from business advisory, well-being advisory, and of course some tourism business chat, just to add to the entertainment. So anyway, all there for you to enjoy on the website. So thank you ever so much for joining us. We've now got to turn around and say thank you very much and give you one last disclaimer. Thank you very much. Thank you for joining us. Goodbye.